Personal finance is often taught in this one-size-fits-all manner, but what got you here won't get you there. And the things that you need to do in order to get from the beginner stages of your money journey to more advanced stages completely change. Sometimes you have to do at the end of the journey the opposite of what you did in the beginning. So to talk about every step of the journey and how it's different for going from a beginner to more intermediate to more advanced, we have with us today the COO of Ritholtz Wealth Management, Nick Maggiulli. He is the author of Just Keep Buying, and his new book is called The Wealth Ladder. Welcome to the Afford Anything podcast, the show that knows you can afford anything, not everything. This show covers 5 pillars: financial psychology, increasing your income, investing, real estate, and entrepreneurship. It's double I fire. Today's episode focuses on 4 out of 5 of those letters, really? Maybe all 5 of those letters. We're going to be talking about financial psychology, mindset. We're going to talk about increasing your income. We'll talk about investing. I guess we may touch on real estate. We'll see. And entrepreneurship is going to be a big piece of it. So yeah, today's episode covers all 5 of the letters of what we talk about on the show. Welcome, Nick.
Yeah, thanks for having me.
Thanks for being here. So what got you here won't get you there. Talk us through this concept of how personal finance advice changes depending on what stage you're in.
The idea with the wealth ladder is that there are different levels of wealth, and in each level, there's different investing advice, spending advice, income advice, etc. And so depending on which level you're in, you might have to take a different strategy and a different approach, right? And we can definitely get into that. I can expand on what those levels are, etc.
I'm sure some people who are hearing this, and in a moment we'll talk about what all of those levels are, I'm sure there's some people who are hearing this who are having an immediate knee-jerk reaction and saying, well, wait a minute, isn't spending less than you earn always valuable advice, regardless of whether you have a net worth of $100 or $100 million?
Yes, of course. That's still valuable advice. But I think what a lot of people get themselves tripped up on is as their wealth goes up or as their income goes up, they start to spend more. And I think that's okay. I think your spending increasing with your income makes sense. It just needs to increase at a slower rate than your income. So that means you're always saving more, right? So that's one way to think about that. And I can talk about the spending rule that gets you there and the different ideas related to that. But you can spend more as you earn more. It's just a question of how much. The wealth ladder actually has a rule for this that will solve that.
Yeah, it's the 0.1% rule.
Yes, 0.01% rule. Or you can think of it as the 1/10,000th rule. All your assets minus all your liabilities. You divide that by 10,000, and that is the marginal amount of money you can spend on a daily basis without impacting your wealth. So let me just run a quick example. Let's say your net worth's $10,000, right? Let's say your income and your spending is completely the same, right? You spend every dollar you earn, right? If you have $10,000 in wealth, if it's growing at a 0.01% per day, that allows you to spend $1 per day, on average, and you would stay at the same level of wealth over time. By the time your wealth hits $100,000, you can spend $10 a day. By the time it hits $1 million, you can spend $100 per day, etc. Now, once again, this is in excess of your income. So this is kind of like that marginal decision you make when you're like at a grocery store, when you're at a restaurant. Like the difference, the size of that spending decision is determined by your wealth. And so, for example, the levels here, once we get into the levels, I think it'll make more sense. But level 2 is what I call grocery freedom. And that's a net worth between $10,000 to $100,000. And so the idea is the marginal spend is anywhere from $1 to $10. So when you go to a grocery store and you want to, I want to get this slightly nicer eggs or the slightly nicer cottage cheese or whatever you're buying, you can spend that extra marginal $1 to $10 on that item without worrying about it, right? That's kind of the idea. And that scales as you gain wealth, right? And it changes categories, right? Level 3, which is $100,000 to $1 million in wealth, that's what I call restaurant freedom. So you can spend, $10 to $100 more when you're at a restaurant. That's kind of like the idea. And so I think most people spend on the margin. And so thinking about spending in this way, I think is very helpful because it allows you to spend a little bit more without necessarily jeopardizing your wealth.
So with the 0.01% rule, the mental shortcut is it's $100 per every $1 million of net worth.
Yep.
So if you have a $500,000 net worth, that's $50.
Yep.
You got $1 million net worth, it's 100. If you have a $2 million net worth, it's 200, etc.
Exactly.
And that is excess daily spend, and you said that that's in addition to your income. So would that mean, hypothetically, let's say you have a $1 million net worth, so we're talking about a $100 excess daily spend according to the 0.01% rule. And let's say you have $1 million net worth, let's say that you have an income of $100,000. You save, we'll just make it easy and say your take-home pay after taxes is $100,000. And you save 20% of your take-home pay, and you're just committed to doing that forever. So you save that 20%, you live on $80,000 a year. Does that mean that you can spend $80,000 per year plus spend an additional $100 per day?
Yes, exactly. And so I think the whole idea of this rule is not to, we can get down to the fine details like this, but the idea is, okay, where can I spend more money and not have to worry about money, right? And so I say level 2, grocery store, right? So you have $10,000 to $100,000 in wealth. Don't worry about kind of what you spend at the grocery store. Once you go $100,000 to $1 million, which is level 3, you don't have to worry as much as restaurants. And then once you go level 4, which is $1 million to $10 million, I call that travel freedom. So you can start to spend more. You can start to upgrade your seat a bit more. Of course, right at the beginning of $1 million, you may not be able to do that too much, but you can get a better seat, get a window seat. Oh, I want more legroom. Like you can do stuff like that, stay in a slightly nicer hotel. And as you do that over time, what this allows for, as your wealth grows, you get to spend more, and it also doesn't jeopardize like your financial future. That's the idea. So in your example where someone's spending 80 grand, they're already saving 20 grand a year. So they can, in theory, could spend that and their wealth would stay flat, all else equal, right? Of course, we don't want that. We want them to grow their wealth. So they're saving 20 grand a year, which is great. And then on top of that, they could spend $100 a day on top of that, and they would still see their wealth grow over time, right?
Let's actually stay at that example then. Let's say that your take-home pay after taxes and deductions is $100,000 a year. And let's just assume that you spend the full $100,000 a year, and you have a net worth of $1 million. So you're spending every penny that you bring home, and you also spend an extra $100 a day on top of that. I'm assuming you pull that from your investments.
You could assume your investments are earning 0.01% per day, which is annualized 3.7% per year.
So you pull that from your investments, and that basically then would be enough to keep you flatlined.
Yeah, you would be. I mean, this is on average, of course. If the market's down 50% in a year, this is not going to work, right? But on average, if we assume that your wealth grows at 3.7% per year, which is very conservative, I don't think anyone's going to argue with that, then we can assume that you can spend that level of, and your wealth would just stay at $1 million indefinitely. That's the assumption. Of course, the real world's much messier than this. I think most people who have $1 million and probably have a decent income are saving money, and that's good. The whole idea is just creating some sort of heuristic. So like, when can I spend more money and not worry about this? And I wanted to provide a little bit of lifestyle creep over time without going overboard. Because I think never spend any more, don't have any lifestyle creep, I don't think it matches the data. I don't think it matches, human nature. People want to reward themselves for doing well. And so this rule, which we've kind of gone through these specific details, is just a simple way for you to say, hey, you know what? I'm in this wealth level. I can splurge a little bit more in restaurants now, or I can go and upgrade my seat on an airplane, right? And so, for example, when I was in level 3, I never did any sort of travel freedom. I always took the cheapest seat, the cheapest everything. Now that I've slowly kind of gotten into level 4, I will upgrade my seat. I will do small stuff like that. So my behavior has changed based on this. I actually use this rule. I came up with it obviously after the fact, but I came up with it while I was building wealth. I didn't know it from 10 years ago or something, but that's kind of the thinking that I actually use, and I think it's very valuable in that sense.
The assumption that it's predicated on, which is that your money grows at an annualized average of 3.7% a year. You said earlier that that's very conservative. Nobody would argue with that. And one thing that strikes me is when I think about the overall growth across your basket of total investments, of course, your equities, your stocks are going to grow on a long-term annualized average at a much higher rate. But you're also going to have a bond allocation. You're also going to have a cash allocation. So across the entire basket of all of your money, it is actually quite feasible that you might be at, depending on how big your bond and cash allocation is, maybe 4%, maybe 5%, maybe 6%.
I try to, everything I do with future estimates is 4% real returns. This is even more conservative than that. And it's also simple, right? And it's okay, take my wealth, divide by 10,000. That's the number I can spend on a daily basis. Of course, what if you don't spend it for a week? Could you pool it for a weekend? Yes, you could. There's all sorts of ways you can play with this rule. I think I just want to keep something simple, oh, hey, I have a little bit of travel freedom. Oh, I have restaurant freedom, etc.
You also had another rule, and wasn't it whatever you buy, make sure you can double that? If you buy a pair of shoes for $100, then make sure that you actually can afford $200 for those shoes.
People like that one as well. That's called the 2X rule. So if you want like a pair of nice high heels as a woman or a nice pair of leather shoes as a man, whatever it is, let's say you're spending $300 on these shoes. Okay, save double, save 600. Take the 300, buy the shoes, take the other 300 and invest in a diversified portfolio or the S&P 500, whatever you want. It doesn't really matter. Invest it or give it to charity. There's a lot of different things you can do with this rule. I like coming up with these rules because every person's going to have different feelings and reactions to them, and some will attach to one rule more than another. And so I don't think any one of these rules is completely correct. I think I'm just trying to provide options for people because I do think the spending guilt is very deep in our society, and I don't want to name names. I think there's a lot of very popular personal finance people out there who are very anti-spending in a lot of host of ways about, lattes and all this other stuff, which is kind of crazy. I know you've had people on this podcast who've discussed these ideas before, but I'm just trying to reverse that. So I'm like, hey, if you don't like this rule, try this rule. If you don't like this, try this. I think there are different ways of looking at it. I personally like the 0.01% rule, even though it's a little more technical, because it moves over time, right? And so the 2X rule is great as well, but everyone kind of will see what they like. And so I've talked about both of those.
Let's talk then, since you mentioned it moves over time, let's talk then about the wealth ladder and what the various stages of the ladder are. So there's 6 stages. Walk us through starting at level 1.
I'll also give some data as well. I think this is going to be helpful for your listeners because understanding, okay, well, how many people are in this wealth level, et cetera. So this is U.S. household. So this is if you have a spouse or something that includes both of your net worths together. Basically, 20% of U.S. households are in level 1. That's less than $10,000 in total wealth. So once again, include your home equity, include your vehicle, the cash in your bank accounts, your retirement accounts. Take all those assets, then take out all your debt. That's student loans, mortgage, credit card. You take that difference, and that's your net worth. That basically determines where you fall on the wealth ladder. So once again, level 1, less than $10,000, that's about 20% of households. Level 2, that's $10,000 to $100,000. That's also about 20% of households. Level 3, that's $100,000 to $1 million. That's what I would call like the middle class. That's around 40% of households. So I know people say the middle class doesn't exist, but if you actually just look at the wealth data, like they are there and they are the largest cohort. Level 4, that's 1 million to 10 million. That's going to be about 18% of households. And then level 5, which is 10 million to 100 million, and then level 6, which is 100 million or more, those two cohorts represent the top 2% of households, right? So going through it again, 20% in level 1, 20% level 2, 40% in level 3, which is 100,000 to a million, that's the middle class, 18% in level 4, that's 1 to 10 million, and lastly, you have 2% in the level 5 plus, we'll just say. Because, there's so few households there that there's not a lot of data on them, and then it's very hard to track as it is.
Let's talk through how a person can move through these different levels across the span of their life. We'll start with a person who's 18 years old, they have a 0 net worth. They're at the beginning of level 1.
Yeah, there's a lot of different ways this can happen. So let's say you're in level 1, you're 18. There's a few different paths you have. Most people, or not most people, there's a good portion of the United States, I'd say maybe a third to 40%, will end up going to college. They'll get an education that ends up getting them a job that gets them out of level 1, right? You get that education that raises your income.
But it also gives you a negative net worth.
Yes. Eventually, it can give you a negative net worth, but you'd hope eventually the income increase that you wouldn't have had if you hadn't gone to college end up getting you out of level 1 eventually, right? That's one path. Second path is you just start working at 18, right? Mm-hmm. And there's different ways, different jobs you can have. You can start working at a grocery store and work your way up. You work at a Chipotle and become a Chipotle manager, where they're making 6 figures now. So there's a lot of different paths there. The thing I like to focus on in level 1 is just getting that safety net, right? Because having that emergency savings is so important. And I like to think in every wealth level, something is being amplified in your life. And so in level 1, I think the thing that's being amplified is bad luck. And what do I mean by that? Something that is just an annoyance for someone in, let's say, level 3 or level 4 could derail your life completely in level 1. And so, let's just take a simple example. Let's say you have a car, you drive to work, you get a flat tire. You don't have money to replace the tire. Okay, so you just can't get to work now. If you can't get to work, you could lose your job. You lose your job, you get behind, get on a credit card debt. You could just see how it spirals out of control from there. That's a very simplified example, but it goes to show how just a simple piece of bad luck is just so much worse for someone in level 1 than it is for someone in level 2, et cetera, right?
Right.
So the thing I focus on in level 1 is like, hey, you're 18 starting out, whatever you're doing, find a way to just get some sort of safety net. And it doesn't have to even be you. If you have friends or family that can help you and just like provide that initial safety net, that's great. And then find ways so that you can actually do that for yourself. You want to get some sort of just base level of self-sufficiency. And it's okay if you have some debt. That's not the end of the world. But if like, once again, if one of these bad luck events happens to you, it's not going to knock you out completely. That's the goal. Because debt, you can pay that over time. That's not necessarily always an issue. It depends the type of debt as well. But that's what I would focus on in level 1, that starting out person.
Right. Level 1, it sounds as though the focus is survival.
Yes, exactly.
So how would a person progress then from level 1 to level 2? Is that simply just a matter of time? Time and anything over 0 compounding?
Yeah. So I think time is going to be consistent throughout the wealth ladder, and we can get into that, especially at the higher wealth levels. The median age in each wealth level just keeps going up, and it goes like, for example, the median age in level 4 is 62, and we'll get into that. Getting to $1 million is not 20 and 30-year-olds, and we can get to that. But so in terms of that time is a piece of it, but I think it's getting skills that can create the income that makes it easier to save money. And I think we like to demonize, poor people and say, oh, look, they spend all their money on this and that. But if you actually look at the data, they don't have a lot of places where they can cut. They're spending everything just on necessities. They're not splurging all that much. They just don't have income. I haven't seen a data set that shows otherwise. And it's great to be like, oh, look, I'm doing well because I made the right decisions on this and that. It's like, well, you also had a decent income. And maybe your decisions led to that income, which is great, but it's not just like spending decisions that are the problem. And so I don't want to demonize the spending issue. I'm not saying that there aren't people that have spending problems in level 1. There definitely are. But I think for the most part, if you look at it, it's an income issue, not a spending issue. So that's the thing I would say is like, find ways to get those marketable skills so that you can start saving money to get out of level 1. And once again, 10,000, that's your net worth. So you could have a car that's worth a few $1,000s. You could have a couple $1,000s in a checking account. You could maybe start a stock portfolio. Whatever it is, there's going to be some combination that's going to help you get there.
I agree completely. Actually, it goes back to the theme of personal finance is not one size fits all. So much of personal finance advice out there is spend less, spend less, spend less. Like a lot of advice really focuses on frugality. And where that falls short is, as to your point, in level 1, which, as a reminder, is a net worth of between $0 to $10,000,
or even just less than 10,000. It could be a negative.
Okay,
net
or
worth.
negative.
Yes.
Yeah. A net worth of less than $10,000. In level 1, you don't have a spending problem. You have an income problem. And maybe actually on this topic, you can talk about the correlation between income and net worth, because you've actually found data that shows how well correlated these two are. And this is something also, people often say like, well, no matter what your income, if you're just great at saving and investing, you can build a big net worth. And you can build a good net worth relative to your income, but you've found data that shows that even people with a lower income who have the highest net worth of their income cohort still have a lower net worth than people with a high income who have a low net worth relative to their cohort.
Yes, I summarize that as it's very rare to have low income and high wealth, or high wealth and low income. This is by wealth level. I'm just going to read the median household income in each wealth level, right? So level 1, which is less than $10,000 in wealth, the median income there is $32,000. Level 2, which is 10K to 100K in wealth, the median income is $47,000. Level 3, the median income is $83,000. Level 4, the median income is $197,000. Level 5, that's for people with $10 million to $100 million in wealth. The median household income is $724,000. And in level 6, the median household income is $4.3 million. Wow. So you see it just launches up. Now, of course, these feed on each other. If you have $100 million and you're earning, let's say, 4% a year, that's just on that, just your investment portfolio is generating you $4 million a year. So this whole level 6, 100 million plus, looking at the number 4.3 million, that shows that the investment income is probably or business income is a large portion of that. So it's something to keep in mind when you're thinking about these things, is these things are a flywheel and they affect each other. And as you get wealth, you're going to start, and you're investing that wealth, obviously, you're going to start having more income, and it's just going to feed on itself. So something to keep in mind there. And yeah, once again, I don't want to go through all these numbers here because it's just a little complex thinking about saying this just through a podcast, but I have a table in here which says hey, if you're in the lowest income group, how is wealth broken out across each one of these income groups? And then as you can see, those with the lowest income, tend to have the lowest wealth, right? Even the highest wealth people in the lowest income group have less wealth than the lowest wealth people in the highest income group, which is, once again, it's a tongue twister.
It's a tongue twister, but it's a little bit like newsflash. Earning more money leads to having a higher net worth. But it's good to have the data to back it, because there are so many voices in the personal finance space that finger wag and say, well, it doesn't matter how much you make. It matters how much you spend. No, it does matter how much you make.
Yeah, and the data, it's just so clear. It's the strongest relationship I've seen in personal finance. And I'm just so tired of the spending argument. I wanted to put it to bed forever. I haven't found a better data set on this. And if I do, I will change my tune. But until then, I will stick with what I have. So.
And for those of you who are listening via audio, I would encourage you to watch the YouTube version of this interview, because we will be showing the numbers on the screen. I know sometimes it's hard in audio format to listen to a bunch of numbers, but when you visually can see numbers written on a screen, it sometimes helps the information absorb a little bit better. So youtube.com/affordanything, check out the video version of this, and I think that'll allow some of these concepts to gel a little bit more. So in the YouTube video, we'll show the charts, we'll show the table, we'll show all of the visuals.
Yeah, I think that'll help, solidify some of these.
So we've talked about what to do when you're in level 1, which means that you have a net worth of $10,000 or less. Let's talk about what happens when you get to level 2, which is a net worth that's between $10,000 to $100,000.
Yeah, so I think the big thing to focus on in level 2 is education and skills. And that's still true in level 1, but I think it's even more true in level 2, because if you think about the trajectory of your career path, like if you can get the skills that increase your income, like that can set you up to end up saving so much more. And so I keep coming back to income, and I know like it's beating a dead horse, so to speak, but it's so true in the data. And if you actually look at the difference between households that, let's say, stay in level 2 versus those that make it out of 2 and go to level 3, and we do this like over the course of a decade, I've looked at the same set of households. This is not different households, the same set of people over time. The ones that make it to level 3 either A, had a higher starting income, and they also generally spent less relative to their income. They might have spent more money than those that stayed in level 2, but as a percentage of their income, they spent less. And so the main thing to take away there is like those that are earning more are making it up higher up the wealth ladder, right? And so I've looked at all this data, and that's just like the overwhelming overarching point there. It's the thing to focus on. And why I say education, because it doesn't have to necessarily be a college degree. It could be a trade school. It could be coding boot camps. I know now people are like, oh, coding's all solved by AI. And I don't believe that as much. I think there's a lot of things that coding can do. I think having those skills is still very valuable, even if right now, yes, it looks like, oh, we're never going to need software engineers again. I'm a little bit of a programmer. If you've actually tried to code something up just from scratch, these things are pretty dang good. I'm very impressed by them, but they have not completely solved it. And if you think they have, like, you haven't actually done it yourself. So I still think these skills are valuable. And it's like figuring out what are those skills that are going to be useful in the future and working on those and then finding a way to increase your income. That's the end goal for all of these things, because that's what builds wealth. And there's just no way around that.
Learning how to negotiate as well. So either asking your boss or supervisor for a raise, or angling for a higher starting salary when you are switching jobs. That's a major piece of it, because there is variation between how much two people will get paid for exactly the same role at the same company. And sometimes that variation can just be based on who was better at asking for more money.
Yes, that's completely true. And I think that it's actually overlooked. I think negotiation is one of the best skills you can have, because like people will spend hours looking through coupons, trying to find deals and this and that. They won't spend that same amount of time on a negotiation, which could have a much bigger impact, right? You're getting a multi-$1,000 raise, or even a few dollars per hour if you're paid hourly. Like those little things add up in much bigger ways than trying to find a deal on Facebook Marketplace or something, right? And so I think it's one of those things where a lot of people don't prepare, and I think you need to rehearse and go through it. And what if they say this? What should I do? Think through that, rehearse it with someone you know and trust, and I think you'll actually see that it's quite a good exercise to go through, and just thinking about how that would play out.
It's a money-making skill.
Yes, it is.
So increasing income is key to ascending the wealth ladder, but there are endless income-producing opportunities, some of which are worthwhile and some of which are not. So, for example, any of us could sign up to drive for Uber right now, assuming that you have a driver's license, right? Any of us could sign up to drive for Uber. And for some people, that investment of time will be worth it, and for others, it won't be. Is there a heuristic for making that determination as to whether or not it's worth your time?
Yeah, so in terms of the wealth ladder, the rule I came up with, unlike the 0.01% rule, I call this the 1% rule. So instead of taking 0.01% of your wealth, you just take whatever your wealth is and take 1% of it. And that amount is the minimum amount you should consider doing something for, right? So let's go through an example. If your net worth is $100,000, you should only look at income opportunities that will eventually kind of get you $1,000 total. Of course, it's divided by the amount of time you put in as well, but I think it's a very simple heuristic. If someone's like, hey, would you do this thing for me? It's going to take a few hours and you're going to get paid $50. It's like, if you're worth 100K, that's probably not worth your time. If you're worth $1 million, it's probably not worth your time. If you're in level 1 and your net worth's less than 10,000, you probably should take those opportunities, right? And so it's just a very simple heuristic, but it's just like, hey, like, let me think about this opportunity, and is this going to add at least 1% to my net worth? If not, then maybe I should pass on it. And I think as your wealth grows over time, you find yourself thinking like, yeah, should I keep doing this? I'm not sure. And I think a lot of people don't necessarily do that, and they just keep doing the same thing over and over, like, hey, this worked. But at some point, like, you're not going to get the same return, right? At some point, like, the thing that used to add a lot of value to you, I mean, literal value, like to your net worth, is not going to. So unless that thing is growing over time, it's just something else to consider when you're thinking about that.
And so what's interesting to me about that heuristic is that it measures, is this job or is this project worth my time? Mm-hmm. It measures that against net worth rather than against your hourly rate, some measure of your compensation. Because so much of the time when we hear different heuristics around making that determination, we hear it as a function of your compensation. So let's say that at your day job, at your 9-to-5 day job, you get paid $60,000 annually. Mm-hmm. Well, assuming that you work full time, which is 40 hours a week times 50 weeks a year, so you work 2,000 hours a year. So a $60,000 salary means that you're making $30 an hour, but, you know, ignoring benefits, right? And so you use that as a heuristic and say, well, am I making at least $30 an hour or more? Which is another way of saying, am I making at least as much as I'm making in my day job? This is different, though, because in this, you're not looking at what you earn, you're looking at what your net worth is.
Mm-hmm. I still think hourly rate is very useful. It's the first starting heuristic. But if you're thinking about this, you're like, hey, 1% of my net worth at $60,000 is $600, right? Does that mean you need to make $600 an hour? No, but if there's a project that someone's willing to hire you for, the question is, over the life of this project, is this going to make me $600 at least, right? And otherwise, you probably shouldn't even spend the time. Because remember, a lot of projects, you have to go talk to the person, set things up. It's not just like, oh, I just spend the time to do the project. There's other hidden costs and hidden time costs that you're not thinking about. So let's say my net worth's $1 million. If someone's going to come and bring an income opportunity to me, and if it's not worth at least, $10,000, I'm going to say like, I don't know if I want to do that, right? Of course, it depends the time too, right? But I think thinking about those types of things is kind of what matters when we're determining what type of opportunities we pursue or we don't pursue, right? Like I think writing a book is a larger income opportunity than that $10,000 opportunity, right? In the case of like, $1 million, using that as our benchmark, right? So I would be like, okay, yeah, I'd be willing to write a book, but maybe I wouldn't be willing to do something else that wouldn't pay that.
What would you do if the income is uncertain and there's a chance for a big upside, but there's also a chance that it might falter?
That's a very good question. I think you have to, kind of imagine the future in some way and say like, what's the median outcome here? And going from that, then determining this is an art more than a science, right? And so I'm trying to come up with rules that help people. And I think it's mostly about just waking people up to be like, wow, I've never even thought of using that. The hourly rate is actually a very good starting point. And it's where most people should start with, is actually using an hourly rate. But then in addition to that, say, hey, okay, well, as my wealth grows, like I need to really be more protective of my time. I think it's another thing people don't think of, right? And so you're just saying, oh, well, that's my hourly rate. I should just always give up my hourly rate. Well, not necessarily. I think as you gain more wealth, like your time, should be more valuable in your head so that you protect it a bit more. And I think the people that don't do that end up working so much and they only value money and they overlook a lot of other things in life.
How long might it take a family to get out of level 2? So again, level 2 being a net worth of between $10,000 to $100,000. How long would it take through saving your income, investing? How long would it take to make it to that next order of magnitude?
I don't have the exact number of years it typically takes, but I can tell you all the data we have is like snapshot data every few years. And so let me give you an example. If you started in level 2, after 10 years, 44% of households would be in level 3, right? So like a decent number, right? How many would make it to level 4? About 1%. So within 10 years, right? I'm going to give you the same data again. By the way, if they're not in level 3 or level 4, they're still in level 2. So for example, 38% of households that start in level 2 end up staying in level 2. You can still build wealth. You can have a net worth of, let's say, $15,000 when you start, and then 10 years later you have a net worth of $80,000. You still built wealth, but you're still in the same wealth level. But anyways, going back to over a 20-year time span, so not just looking at a 10-year time span, right? Over a 10-year time span, as I said, 44% of households went from level 2 to level 3. Over a 20-year time span, it's actually 55% of households, right, make it to level 3. And if we say how many of those make it to level 4, over a 20-year time span, it's about 5% of households become millionaires. And once again, level 4 is 1 million to 10 million. Just as a quick aside, like the levels are pretty easy to memorize. Once you know one of them, you just multiply or divide by 10 to get to the next level, right? So if level 2 is, 10,000 to 100,000, level 3 is just 10x of that, which is 100,000 to a million, and etc. This data, it goes to show 60% of level 2 households are going to either be in level 3 or level 4 after 20 years. That shows some good mobility, and obviously 20 years, there's time, people are older, they've saved money, etc. But it shows that there actually still is, financial mobility in the United States, at least historically. We could argue about that going forward, but people say, oh, there's no mobility, but this data shows there definitely is, right?
And is that with adjusting for inflation? Are we talking about purchasing power parity?
Of course. All this is adjusted for inflation. I did everything in 2021 dollars and just took all the prior data, which goes back to 1984, and I just adjusted all for inflation and just averaged out all the 20-year periods in there. So 1984 to 2004, and then the next one, which is 1989 to 2009, etc. Took all those 20-year periods, looked at all those household changes, and then I quantified all that. So it's a lot going into that, but yeah, I'm looking at real purchasing power changes. And of course, because of inflation, that's going to happen. It's like, no, this is real purchasing power changes and real wealth being built.
And is the primary way that people in level 2 ascend to level 3? We've established that there is that mobility. The data shows that that does exist and that does happen. What is the primary mechanism through which that happens?
I think for the most part, it's having a higher income.
Then what do they do with that higher income?
They save it, and obviously you don't have to invest it. There's obviously some investing going on, but I can't say with certainty that that's everything. I think most of it, personally, if we actually look at the investment data for households in level 3, so let's assume you made it out of level 2 into level 3, the biggest asset for those in level 3 is their home. So what do they really do? A household that goes from level 2 to level 3, and let's say they don't get beyond level 3, they buy a home, they're saving over time through the equity in their home, and that's kind of how they do it. So I can tell you from a balance sheet perspective, that's what we see in level 3. So if I know a household went from level 2 to level 3, and assuming like the typical level 3 household, that's what we're going to see, right? And typically among those that own a home, in level 3, around 65% of their assets end up being in their house, right? In level 2, it's something like 75%. In level 4, it's only 30% in their home. By level 5, it's 10%. And then for those in level 6, it ends up being less than 5% of their total wealth is in their home. So if you're saying, how are people actually getting there, at least in terms of net worth, it's through purchasing a house.
That actually raises an important point, which is we've been talking so far about net worth as a singular unit. But the assets that comprise a person's net worth shift as they move through these different levels. And so, as you've just stated, a person's primary residence is the bulk of their net worth in level 2 and level 3. How do other assets start becoming bigger pieces of the mix as you ascend through level 3, 4, 5?
Yeah, so the main difference, if I have to classify this, is levels 1, 2, and 3. The majority of their assets are in non-income producing assets. So that's things like cash, let's say. And so cash can actually produce some income, but let's just say it's really non-income producing. Your home, your vehicle, right? These are things that are not necessarily paying you. Now, when we shift to level 4, 5, and 6, the big difference there is that's where you have more stock ownership, more money in retirement accounts, bonds, other real estate outside of your home, and private business ownership, right? And it's very clear in the data. If you just look at like the percentage of a household's assets that are income producing, you're seeing that it's just increasing in each wealth level to the point where that's the main summary of like looking at the asset level data is that by the time you get to level 6, let me look at the data here, over 80% of their assets are income producing, right? Compared to someone in level 1 who has on average 5% of their assets are income producing. So, and the reason why is someone in level 1 doesn't have a lot of money, right? So it makes sense why that's the case. And so they can't afford to go and buy a second property. I can't even get my first property, right? So it's like, it's very obvious when you say that, but But when you actually look at the data, it's very interesting that there's this huge step function in the sense that in level 3, 20% of the assets are income producing. By the time you get to level 4, it's 50%. So there's a huge jump in kind of how people use money as they go up the wealth ladder. And so it's something to keep in mind and say, okay, well, how do I want to get to level 4? Like, what are the types of things that people in level 4 do? Well, they own a lot of income producing assets. Whether that can just be ETFs, that can be individual stocks, that could be physical real estate. There's a lot of different ways to do it, but that is just based on the data, kind of what their balance sheets end up looking like.
It seems as though a lot of, like, the bulk of personal finance advice is for people who are in levels 2 or 3 who want to get to level 4, which is another way of saying the bulk of personal finance advice is for people who have a net worth of somewhere between 10,000 to a million. Yeah, it's a wide range, but somewhere in that range. And they want to get to a net worth that's in the single digit millions. As you've talked about, that is levels 2 and 3 together comprise about 60% of the U.S. population. So that is the majority of the U.S. And it seems as though most personal finance advice is really directed towards that, which leads to the question, once you get to level 4, then what? There's not quite a lot of information about how to ascend beyond that.
I think that's probably for good reason, though. I think getting to level, like going beyond level 4 requires a very different set of actions than what caused you to get into level 4. As you introed the show, like what got you here won't get you there, right? And that idea, I think, is very powerful. The only difference, I think, between level 3 and level 4 is really just going to be your income. That's going to be the main driver. But if you are investing over time, saving money, doing all those things, being diversified, I think you can get to level 3 or level 4. It just depends on how large your income is, right? If you have a job that's paying you higher in the 6 figures, it's going to be easier for you to get to level 4. If you're paying maybe not even 6 figures, then you can probably get to level 3. So it really depends on your income. But putting that aside, like getting to level 5 is a whole nother beast in itself, because the types of jobs that get you there are very rare. For example, I can only think of like entertainers, right? You can think of like celebrities, musicians, athletes. Those people can get to level 5 doing that, but they have to also be pretty highly paid. So it can't just be any athlete. Like you have to be kind of a little bit of a star, and then you have to save your money. You have to actually do quite well doing that to get beyond 10 million. But outside of that, for the typical person that's not in one of these like outlier occupations, we'll call it, you're going to have some sort of business ownership. You either need to have a little bit of equity in a very large company. So you're like at a startup or something, or you go join like NVIDIA before its stock goes bonkers, or you own your own business and you grow it. You own all the equity in a smaller business that you end up selling for a good amount of money, whatever that is. It could be 20 million, 50, 100 million, something like that, right? And then after you sell that, that's when you've now turned that business equity into wealth of that level. So, and you can see that those actions are very different. Like working a job, saving money, investing it in a index fund is very different than, I need to start a business, build the business, and then one day sell it for a lot of money, right? So those actions are completely different, and that's why once you get into level 4, I call it the no man's land of wealth, because you're basically going to be there forever unless you can make that change to go get a business of some sort and sell a large portion of it for a lot of money.
I have some follow-up questions to that, but before we get there, I realized we've sort of skipped over level 3, and I don't want to shortchange level 3 because that is 40% of the population. So once a person has progressed from levels 2 to 3, what are the best practices as well as the biggest mistakes that you see as a person moves even from the beginning of level 3, which is a net worth of 100,000, to the end of level 3 as they approach a net worth of $1 million, their first $1 million?
Yeah, so I think the big differentiator there is how much are you investing over time. And once again, as we saw when I was talking about earlier, like the percentage of income producing assets in level 3 is like 20%. By the time you get to level 4, it's 50%. So there is a big shift in like the balance sheet and ownership. And so what's happening is like, if you're not really investing a lot of money and you're already in level 3, you probably need to start investing. It's not just like, you start investing, you're going to be in level 4. Like, no, once again, the median age of someone in level 4, which is 1 million to 10 million, is 62. So if you took all the households in the United States that have at least $1 to $10 million in net worth, you put them in a room and you took the middle age, right, the median, that answer's 62, right? So it's not people in their 20s and 30s. In fact, only 1% of households make it to level 4 before age 30. So it's an incredibly rare thing. I know we see it on Instagram and Twitter and this stuff all the time, but that is an incredibly rare thing to do, and you should not expect that. So a lot of this is time as well. And I know I've touched on this earlier, but time is going to be one of the biggest factors. Like, you got to get everything set up and then just keep moving in that direction, and time will naturally build your wealth, right? Because not just from the investment returns, but you have more time to save money. You have more time to put it away, right? So all those things are what creates that value. And so the first thing I would say is, like, don't be impatient. That's one thing.
What percentage of level 3 households get to level 4?
So let's do this over 10 years. So over 10 years, about 18% of households that are in level 3 make it to level 4 after 10 years, right? So it's like 1 in 5, right? It's not impossible, but it happens. And then over the course of 20 years, it's actually 28% of households that are in level 3 make it to level 4, right? So it's not everyone. Not everyone's going to make it out of there, but I don't think level 3 and level 4 are all that different. I know they may, and you're saying, what are you talking about? You're saying someone with 500,000 and someone with 5 million has a similar life. In many ways, yes, though. I think the only difference is, like, they just have luxuries. They have, like, slightly nicer things. The person in level 3 and the person in level 4 are both sitting on the same airplane. I'm telling you, $5 million is not enough to fly private more than, like, 3 times, you know, and then you're like, okay, I can't keep doing this, right? So someone in level 4 is not flying private. They're probably sitting in a nicer seat. They're probably living in a nicer area. Maybe they're eating slightly nicer food, but outside of that, like, their lives are pretty much the same. There's this line from Warren Buffett where he says, the only difference between me and you is I travel better than you. Outside of that, I drink Coca-Cola just like you. I eat McDonald's. I eat the same food, drink the same stuff. He lives in a very normal house, by the way. Everyone knows this is very public, but the only difference is how he travels. And so that's why I think level 4 and up, it starts to get into that, like, deep travel freedom stuff. And so when I look at this, I'm like, these levels are very similar, 3 and 4, and I think the only difference is status and ego and all this stuff we built on top of that. And so when I'm thinking about level 3 and level 4, I'm thinking that these households are actually quite similar. And that's why I say the level 3 is the middle class and level 4 is just the upper middle class, that's the only differentiator I see there.
Right. That's a great point. The quality of life difference between a person who has a net worth of, say, 700,000 versus a person who has a net worth of 1.2 million is probably unnoticeable. I mean, there may or may not be slight variation, but we're talking about an extra $500,000 in terms of the difference between their two net worths, and yet there's probably not much of a differentiating factor when it comes to the actual day-to-day of what that lifestyle looks like.
Yeah, and unless you plan on actually spending down all of your assets, which very few people ever do, the only difference is just how much you leave to the next generation. That really is a difference, but then how that's being split, that's everything else, right? Because at the end of the day, like, we've done all these, oh, I want to reach financial independence. I need, $100,000 a year. You do the 4% rule. That means you have $2.5 million. Okay. So let's say I wanted $200,000 a year. Now you need $5 million. So don't get me wrong, like 2.5 million and 5 million, they are different numbers. There's $2.5 million, but that only generates an extra $100K a year in income. So $2.5 million, which is a large amount of money, ends up impacting your life by only $100,000 a year. So I'm not saying that's nothing to have an extra $100K a year, but that's not going to get you to fly private. That's not going to get you to be in the absolute fanciest hotels. Like, it will change your life. You can spend a little bit more with that, obviously, but it's not going to change your life as much as you think. And so that's why I think chasing money, as you ascend the wealth ladder, money becomes less and less useful in that sense.
Right. And so how would a person maintain motivation given the declining marginal utility of every dollar?
I think they don't, honestly, and that's why Coast Fire, these different ideas, and for the listeners, I'm assuming you've discussed it probably many times before, but it's just like, I have enough now or I don't have to save anymore and I'll be fine in retirement. I can just let that money grow. I'm going to take a step back at work and spend more time with my kids and maybe take a job or that doesn't pay as much or less hours, cut my hours, or just even do consulting work or something else so I can reprioritize my life. And I think there's going to be a lot of people that are thinking about that now today because there's more households than ever in level 4, right? 18% of the US, that's the highest it's ever been. And this is on an inflation adjusted basis. So I think there's going to be a lot more people saying, hey, I'm not really motivated to do this corporate grind thing. And there's going to be new paths and new ways of living that don't just focus on money as much. And I think you can do that in level 3 too. You don't have to get to level 4 to do that. But I think once you get to level 4, the math starts to become pretty, I don't know if the word's difficult, but it's just, you start looking at it and you're like, wait, I'm doing all this just to barely make an impact on my wealth. Like, why am I doing this? And that you start to wake up. I've actually had friends do this. Like, my buddy was working this job, was really stressed out. His wife was very fortunate. She was early at a tech company. And he's like, I'm sitting here getting yelled at by this person and I'm getting paid less per year than what my wife is vesting in equities. This doesn't make sense. I'm going to take a step back and Now he's coast-firing, and it's great, and he loves it. So just obviously a very fortunate position to be in. That's a caveat of this, but something to think about.
I've also heard the term, because it sounds like he's wife firing. I think they call that Wi-Fi.
Yeah, okay.
Yeah.
Well, it's working, and I guess, hey, they wouldn't. I don't know if I would do something like that, but hey, if it works out for them, hey, more power to them. So.
For the subset of the population that does make it to level 4, what happens next? Given how hard it is to make it to level 5, actually, we'll start with how many people in level 4 do make it to level 5?
Over a 10-year period, roughly 3% of level 4 households make it to level 5, and over a 20-year period, it's 8%. So you're talking less than 1 in 10 are going to make it to level 5 over even 20 years. So there are people that do it. You know, you're a lawyer for 10, 20 years, but a lot of that time you're making good money, but you also own equity in the business, and you probably become a partner, and you start. So that's kind of business ownership, and you're getting paid. So it's a little bit different than just pure compensation. But if you do that for 20, 30 years, yeah, by the end, you're probably making really good money, and you have the investments and all that stuff. So you can definitely make it to level 5 without necessarily having your own individual business.
For the people who are in level 4, is business ownership the predominant path to level 5? I mean, is there any other way? It seems as though VTSAX is not going to get you there.
Yeah, it generally won't unless you do it for a very, very long time, right? So I think if you hit level 4 at 30, and let's say you have like an income of like $300,000, $400,000, and you're saving $100K a year, you can do it. If you hit $1 million and you save $100,000 a year, how long will it take you to get to $10 million? You just hit the cusp of level 4. How long does it take you to get to level 5? Assuming your wealth's growing at 5% a year, you're saving $100K a year, it takes 23 years to get there, right? 23 years of working hard, saving $100K after tax, investing that money, and your wealth has to grow at 5% a year every year. And this is all inflation adjusted, right? That's not easy to do, and most people don't make it to level 4 until they're in their 60s. So who wants to go and do that from their 60s to their 80s? Very few people. They're going to be like, yeah, you know what, I'm good in level 4. I'm going to just retire or coast fire or whatever. So most people won't do that. Let's say you're saving even more. Let's say you save $300,000 a year. Now, once again, this is after tax, so you're saving a lot of money. Your income is going to be probably at least double that, if not more, right? So now you're making $700K. Like, that's an insane income, right? It's a very high income. You're making your household income $700K a year. Still, even if you're doing that while earning 5% a year, it still takes you 17 years to get to level 5. So it's not impossible, but those types of jobs that pay that, there's a lot of stress, a lot of hours involved generally. There are exceptions out there, but for the most part, it's very strenuous. And then you got to do that for almost 2 decades. So that's the cold, hard math behind it. And another way to think about this, I'll just say one last thing on this. If you have $1 million and you're saving $100,000 a year after tax, you're impacting your wealth by 10% a year, right? Just ignoring the changes in the investment returns, your wealth went from 1 million to 1.1 million, all else equal, right? You added 10% to it. By the time you get to $5 million, your $100,000 in savings is only impacting your wealth by 2% a year. You're doing all this math, all this hard stuff. You're saving money. You're not spending as much as you could, right? You have $100,000 in excess, right? So you're sacrificing in some way, all just to change your net worth by about 2% a year. It's just like, why would I do that? That's why I think these coast fire, or I'm going to take a step back, things get so popular. Because at some point, the math gets so out of your favor for your labor versus what your money can actually earn you as investments that you just say, hey, I'm not going to work as much or do something else.
Right. Exactly. Back to the declining marginal utility in every additional dollar that you invest. So the people who are in level 4 who make it to level 5, it sounds as though investing can get you there, but it's going to take you between 17 to 23 years, and it's going to require consistency and dedication and a lot of sacrifice over the span of 2 decades, and that will happen to 8% of people.
The other 92%, most of them will just stay in level 4. They could still be building wealth. They just never make it to level 5. Some of those will go down the wealth ladder for various reasons, which we can get into. But yeah, there's a lot of different things going on there. So
when people in level 4 are making investment decisions, because of course there's more than just broad market index funds that are available to a person. So let's say a person is at level 4 and they want to use business ownership or use investments as a method of making a big bet that might get them to level 5. What are some of the examples that you've seen more broadly of investments and big bets in which some people have made concentrated bets that have sent them to level 5 and others have made concentrated bets that have pummeled them in the wrong direction?
Yeah, I think there's plenty of examples of this where it's not even to level 5. Most of the time it's in people in level 6 who have the bulk of their net worth in an individual business, and that business just goes under for some reason or another. Maybe it's outside of their control. Maybe something happens. Maybe there's a scandal about the business. And as a result, they end up losing basically everything. So they don't even go, oh, it's not like they went from level 6 to level 5. They go all the way down to like level 3 or even to level, 1 technically if you lose everything, right? They don't have anything saved aside or there's a court proceeding. Like you can see stuff like that. But I think concentration is the thing that gets you into level 5, but it's also the thing that can get you out of level 5. So you have to be very careful in how you think about that. So even someone who's starting a business and doing all the stuff in level 4, I would say you want to make sure that some level of wealth is locked up somewhere. And what I mean by that is like it's in a much safer portfolio, more diversified. So even if this bet goes bad, you have something to fall back upon, right? And so I think a lot of people don't think about that, and they say, well, I have to go all in my business because that's how you do it. Well, sometimes it requires that. There have been very famous business leaders that have gone all in. We can talk about Elon Musk has done that multiple times. I know he's a very divisive figure now, but back in the day, he went all in, and he was like, I have to literally put everything I own, all the money I've made off PayPal and all these other things into Tesla because I'm not going to make payroll. And so people have to do these things, and that's how he ended up becoming, one of the richest people on earth, right? Or the richest man now, but it fluctuates a lot. So I think it's something just to think about is like, do you want to make those concentrated bets? And if you do want to make those bets, think about what the cost could be if they don't turn out the way you want.
What happens when you reach level 5, which is a net worth of over 10 million?
Yeah, so level 5, and we'll just do 6 together. I think they're very similar in a lot of ways. So level 5 is 10 million to 100 million. Level 6 is over 100 million. I think at this point, I don't think money is the thing you should be focusing on. I know it's very cliche to say that, but the reason I say that is that every wealth level has something that gets amplified, right? And I think in level 5 and level 6, it's actually all the non-monetary aspects of your life that are amplified. And why do I say that? Because when you're level 1, a lot of your problems are money problems. Like they can be solved literally with money, right? By the time you get to level 5 and 6, you almost have very few money problems. And the problems you probably have to do with your health, your relationships, friendship, a lot of things that money can't buy. You can't just say, hey, cardiovascular system, here's a check for $100,000, like get better, blood pressure numbers or something. You can't do that, right? You can't write your kids a check and say, hey, take this check and love me. Like it doesn't work. I think the focus needs to really shift away from money in a big way because all those other things in your life, you can't use this resource that you have so much of to impact them all that much. I'm not saying it's useless. Of course not. Like money can help. Of course, people that have more money have generally better health outcomes. You can afford better care. I understand that. But at the end of the day, like better care is not going to overcome decades of not taking care of your health or decades of neglecting your spouse or whatever. And like divorce is expensive. Anywhere, it's the most expensive the further you go up the ladder, right? So just something to think about is like, what are all the things I'm neglecting right now because I'm still chasing money? So, of course, there's a lot of money things we can talk about in level 5 and level 6. That's where it's like you need to hire teams of people. You need to have a tax team, a state team, planning. There's so many things we can get into. And like I work at a wealth management firm. That's kind of some of the stuff we do for some of our multifamily office clients. But that's not the thing I tell people to focus on because I'm like, that's probably not your problem. Your problem probably isn't a money issue. Your problem is probably something else in your life that you're currently overlooking. That's going to cause you more problems in the future, and all your money's not going to help you solve that problem. It's true anywhere. Divorce is devastating regardless of your wealth ladder. Falling out of love sucks regardless, but it's just even worse in those levels because money is not going to fix it at all. And so it's overlooked, and I think it's easily overlooked.
It sounds as though those are lessons from levels 5 and 6 that you can incorporate into your life, even at level 3 and 4.
Of course. Very few people are going to ever make it to level 5 and 6. Very few probably even want to. Like, I have no interest in saying, oh, I'm just going to grind away for the next 30 years just so I can make it to $10 million. I don't. I could see myself coast-firing at some point in the future. When? Who knows? I think that the time will be right when that eventually happens. I don't see the point in doing that, and a lot of the people I know that have done relatively well and have said, hey, I'm taking a step back, they seem a lot happier than the people that just keep the gas pedal down, so to speak.
Is there any data about the number of people who are in levels 5 or 6 who fall back down?
So we don't have data on level 6 because the data set I use was from the University of Michigan called the Panel Study of Income Dynamics, PSID. There just weren't any level 6 households in the data because they exist, but they're so rare. I mean, I just think the issue is that there's just not enough data. Like in level 6, most recent estimates show that there's like 10,000 households that have over $100 million in net worth. So the data set I had, the PSID, just didn't have any households in there. But there were some level 5 households, and I can talk to them real quick. So let me do that. And even then, of the level 5 households in the data, there's not a lot of them, right? There's like a dozen of them. So, and once again, it's following the same households over time. So there were level 5 households. And for the most part, a lot of them actually, a good portion of them fell down the wealth ladder. So once again, this is a small sample size. So this is maybe not indicative of all of level 5, but in the data, after 20 years, about half of level 5 households were in level 4. And I don't know if that's because they spent their wealth down, if they had some sort of business, they had a business that was doing well today, they're level 5, and then 20 years later, maybe, the economics of that industry have changed, they've seen a decline, and they've lost some of that wealth, right? So that's roughly half of those households. But still, 40% stayed within level 5, right? And then over a 10-year period, 41% of households in level 5 ended up going down to level 4. So I think it is because of that concentration bias and concentration risk, which we discussed earlier. So I think that's a piece of it. Also, at the same time, the caveat is this is not a massive data set, but it's the best data I have that's following households of that wealth level over a long period of time.
That is particularly interesting to me because it shows, oftentimes when we talk about wealth, we talk about it in a linear fashion in which there is only progress. There's progress and it is linear. And I think the example of people in level 5 going from double-digit millions back down to single-digit millions shows that fortunes can reverse. Is there also data on and fortunes reversing as you go further down the ladder, people in level 4 going to level 3 going to level 2?
Yeah, it's like a matrix which has, along the rows. So on the left side, it says here's your starting wealth level, and then along the columns says here's your ending wealth level. So you can just look. The diagonal would be like how many people were started in level 1, stayed in level 1, or started in level 2, stayed in level 2, etc. And so we can show these visuals, I think, on YouTube, and you can show, hey, over 10 years, here's what the data looks like, and then here over 20 years. I wanted to find this data. I want to be like, how often does this happen? How often are people moving? And why I use these wealth levels, because I really care about large changes in wealth, and I think the levels provide that more than like, oh, someone gained $10,000. Like, yeah, $10,000 matters if you're in like level 1, but by the time you're in level 4, it doesn't really. And so I think people know that intrinsically. And so by structuring it in this way, you can really see large changes and lifestyle changes through wealth.
And we will show youtube.com/affordanything. We will show this matrix so that you can see how wealth moves bidirectionally, which I think is an important part of the conversation that we often don't talk about. We talk about compounding, we talk about growth, we talk about everything as though it's going to be only upside.
Yeah, and I think one of the other things to keep in mind is they were following the same households over time. So someone, quote, losing wealth, there's a lot of different ways this can happen, right? Let's say you're in level 5, you have, let's say, $12 million. You and your partner get divorced. Let's say you cut everything in half. Now you're 2 people in level 4. So no wealth was actually lost, but your household unit would have been reduced. There's a lot of different ways this can happen, a lot of different ways that people can, quote, lose wealth. It doesn't mean that there was like this catastrophic event necessarily, but it's just something to keep in mind. And of course, the data is limited, but it's the best thing I can find. And so I'm trying to do my best to get those answers to people.
Big takeaways that I'm hearing so far are that, number 1, your income matters, particularly to anyone who has less than $1 million in net worth. Your income is probably the single biggest determinant of your ability to advance. Number 2, that owning income-producing assets is what's going to move you up the wealth chain. And number 3, that making big moves, meaning level 2 at a minimum, but at least 3, being secure, being financially secure, and then moving from security to abundance may require some degree of business ownership.
Yeah, I'd agree with all of those, right? Some amount of each one of those. And it depends how you define business ownership. It could be as simple as like, I technically own an index fund, which is like some form of business ownership. If you're talking about private business ownership, that would be like a level 5 plus type of thing, where you have to have your own business that ends up growing quite large and then you sell it. So those are kind of the only caveats I'd put on that, but I agree completely. I think income's the clearest thing in the data, and you've had guests on this podcast that have talked about this. Rachel Rogers talked about this. She's like, my income just exploded. It went from, I was getting paid 30-something thousand, and then in 1 year I made $300,000. That type of income explosion is what allows people to more quickly move up the wealth ladder, right? And so I think it's pretty clear in the data. Most of the people that have done it kind of have seen that, and then just taking that money and investing it either in your own business or in some sort of income producing assets is the ways you keep moving up the ladder, right? And so, yeah, those are the main 2 things I would think about there.
Well, thank you for spending this time with us, and thank you for laying out the wealth ladder as a concept. And also for the 0.01% rule, as well as the 1% rule, as well as the 2x rule, all of these heuristics that we can use as we make decisions about how we spend our time and our money. Where can people find you if they would like to learn more?
My blog is ofdollarsandData.com, but you can also find me on Twitter/X, Instagram, LinkedIn. My name is Nick Maggiulli. You can find me everywhere there. So I try to, and by the way, I do try to answer every single DM. So if you send me a DM, I will respond to you. So.
Wow, that's a lot of work.
Yeah, Ramit actually responds to all of his emails as well, but I know his fan base is bigger, so he is truly the champion of DM responding. So.
Wow. Well, thank you so much.